In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac started a company with a simple idea. They would create a scoring system that told banks how likely you were to pay back a loan. Fair Isaac Corporation. FICO. You've heard of it. Here's what they never advertised. The score they built doesn't measure how wealthy you are. It doesn't measure your savings rate, your net worth, your investment portfolio, or your financial security. It measures one thing only, how reliably you use debt and pay it back. A person with $800,000 in index funds, no mortgage, and no credit cards has a worse credit score than someone carrying $40,000 in revolving debt who never misses a minimum payment. Read that again. My name is Larry, and I have spent years pulling apart the mechanics of systems that are sold to you as tools, but are actually designed to serve someone else's interests. If you've ever felt proud of your 800 credit score and wondered why you still feel financially stuck, this video is going to reframe everything, because the score you've been optimizing for was never a measure of your financial health. It's a measure of your value as a customer to the lending industry. Let me show you how the machine works. Think of the credit score system like a frequent flyer program. Airlines don't give you miles because they want you to travel for free. They give you miles because miles keep you loyal to their airline, keep you booking more flights, and keep you spending money in their ecosystem. The miles feel like a reward. They're actually a retention mechanism. Your credit score works exactly the same way. The behaviors that raise your score, opening credit accounts, carrying balances, making regular payments, keeping old accounts open, are all behaviors that generate revenue for lenders. Every month you carry a balance on a credit card, the bank earns somewhere between 20% and 29% annualized interest. Every time you open a new account, the bank earns fees. Every time you take out a car loan, a mortgage, a personal loan, a lender profits from the interest you pay over the life of that loan. The score rewards you for doing the things that make them money. That's not a conspiracy. That's just how incentive systems work. Here's the number that should disturb you. The average American household carries $10,479 in credit card debt as of 2025. At an average interest rate of 21.5%, that household is paying approximately $2,253 per year just in credit card interest, not principal, not buying anything new, just the cost of carrying the balance that exists. Over 10 years, that's $22,530 paid to a bank for the privilege of having borrowed money at some point in the past. Now, let me show you what $2,253 per year does if it goes somewhere else. Invested at 7% annual returns over 30 years, $2,253 per year becomes approximately $226,000. That's $250,000 that the average American household silently transfers to credit card companies across a working lifetime, money that could have been building their retirement instead. But here's the psychological trap, and this is the part the financial industry never wants you to connect. The credit score system creates a direct conflict between the behaviors that raise your score and the behaviors that build your wealth. Carrying a balance raises your score through credit utilization patterns. Paying off your balance entirely every month is better for your wealth, but can slightly reduce score metrics in some models. Having many open accounts improves your score through credit mix and available credit. Having fewer obligations improves your ability to invest and build net worth. Taking out a new auto loan can boost your score through installment credit diversity. Not having a car payment puts an extra $500 a month into your investment account. The system isn't neutral. It was calibrated by the lending industry for the lending industry, and it has been so successfully marketed to the American public that people now chase a high score the way they chase a high salary, as though it's an end in itself rather than a means to someone else's profit. Let me tell you about a guy I know. We'll call him Kevin. Kevin is 38. He has an 820 credit score. He's genuinely proud of it. He has a mortgage, 2 car loans, 3 credit cards he cycles through to maintain utilization ratios, and a personal loan he took out 2 years ago for a home renovation. Every payment, on time, every month. Kevin is the perfect borrower. Kevin's net worth is $47,000, made almost entirely home equity he can't access without borrowing against it. His coworker Marcus is also 38. Marcus has a 680 credit score. He has 1 credit card he pays in full every month, a modest mortgage, and no other debt. He drives a 2014 Honda he bought with cash. He has been putting $1,800 a month into index funds for 6 years. Marcus's net worth is $312,000, mostly liquid, invested, growing at 7% a year. Kevin has the better credit score. Marcus has the better financial life. The score measures loyalty to the debt system. It doesn't measure proximity to financial freedom. Now, you might be thinking, but Larry, I need credit. I can't buy a house without a mortgage. I can't rent an apartment without a credit check. And you're right. The credit score system is embedded deep enough in American financial infrastructure that ignoring it entirely is not realistic advice. So let me give you the actual framework. Step 1. Understand what you're optimizing for and why. There are 2 completely different reasons to care about your credit score. The first is to access necessary credit, a mortgage, an apartment, occasionally a car. The second is to feel financially successful. These are not the same thing, and most people have conflated them. If you're actively planning to get a mortgage mortgage in the next 2 years, yes, your score matters and you should protect it. If you're not, stop making financial decisions around maintaining a number that primarily measures your profitability as a borrower. Step 2. Eliminate the interest payments before you invest. This sounds obvious. Almost nobody does it in the right order. If you are carrying credit card balances at 21% interest while simultaneously investing in an S&P 500 index fund averaging 8% annual returns, you are losing 13 percentage points per year in a financial transaction that feels like two separate decisions but is actually one. Paying off 21% debt is a guaranteed 21% return. No index fund, no stock, no investment vehicle offers a guaranteed 21% return. The math is not subtle. Pay off high-interest debt first. Not because debt is morally bad, because the arithmetic is non-negotiable. Step 3. Separate the credit tools that serve you from the ones that serve the bank. A mortgage on a modest home at a reasonable rate where the payment is less than 28% of gross income is a debt instrument that can serve your interests. You get shelter. The interest is partly deductible. You build equity. This is a tool that can work for you. A revolving credit card balance at 24% APR is a tool that works against you. A 72-month car loan on a vehicle that depreciates 20% the moment you drive off the lot is a tool that works against you. A buy now, pay later plan for consumer goods is a tool that works against you. The line is simple. Does the debt help you acquire something that holds or grows in value at an interest rate below your expected investment returns? If yes, it may be acceptable. If no, it is a wealth transfer from your future self to a financial institution. Step 4. Build wealth metrics, not score metrics. Most people can tell you their credit score within 10 points. Almost nobody can tell you their savings rate, their net worth trajectory, or the year their investment portfolio will generate enough passive income to cover their basic expenses. These numbers are vastly more important than a FICO score. Start tracking net worth monthly, total assets minus total liabilities. Track your savings rate, the percentage of gross income going into investments. Track your passive income, dividends, interest, rental income, even when it's small, because watching it grow will change your behavior faster than almost anything else. A person who tracks net worth monthly makes different decisions than a person who tracks credit score monthly. Over 30 years, those decisions compound into completely different lives. Step 5. Understand that the goal is to need the system less, not to score better within it. The end game of real financial independence is not an 850 credit score. It is building enough invested assets that borrowing becomes optional. When you have $400,000 in liquid investments, the terms a lender offers you become almost irrelevant because you could write a check instead. When your portfolio generates $30,000 a year in passive income, your monthly cash flow no longer depends on your credit access. The wealthy don't obsess over their credit scores because they've built the thing the score was supposed to be a proxy for, actual financial stability, directly in their own name, in their own accounts. Here's the thing about Bill Fair and Earl Isaac's invention. It was a genuinely useful tool for banks trying to automate lending decisions in the 1950s. It solved a real problem in the financial system, but it was then marketed to the public as a measure of personal financial success, which it was never designed to be. A high credit score means the banks trust you to keep borrowing. That's it. It is a grade on your performance as a customer in their ecosystem. And somewhere along the way, we started treating it like a report card on our financial lives. Your actual financial report card is your net worth, your savings rate, the gap between your monthly expenses and your monthly passive income, the number of years until your investments can replace your paycheck. Those are the numbers worth chasing. The credit score is a loyalty metric for debt. Build enough wealth and you won't need their loyalty program anymore. Subscribe if this changed how you think about it, and drop a comment. What number do you track more closely right now? Your credit score or your net worth? Because the answer tells you everything about where your financial priorities actually are.